Why are Wall Street's biggest players suddenly desperate for Bitcoin derivatives? And what do they know that most investors don't? Today on the TFTC podcast, I'm sitting down with James Check, one of the leading on-chain analysts who's been studying Bitcoin's institutional adoption. James has made some of the most accurate predictions about Bitcoin's consolidation phases and has developed groundbreaking theories about how derivatives will affect the market, theories that are already starting to play out. In this video, we're going to walk through exactly what these new Bitcoin derivatives are, why major institutions have been waiting for them, and most importantly, how they could send Bitcoin's price much higher than anyone expects. What I found most fascinating during this conversation wasn't just the technical details of how derivatives work, but the bigger picture of how they're going to fundamentally change who can invest in Bitcoin and at what scale. I've been investing in Bitcoin since 2013 and running 1031, where we see firsthand how institutions think about Bitcoin allocation. This conversation with James reveals insights that even surprise me about where the market is headed. If you're enjoying this type of content, hit the like button and subscribe to the channel. This is just a small portion of my full conversation with James on the TFTC podcast. You can find the link to the full episode in the description below. Let me break this down into 3 key points that you need to understand about how derivatives are about to change Bitcoin forever. The first point might surprise you. It turns out that Bitcoin has actually hit a ceiling with retail investors, and James explains exactly why this matters.
You actually need derivatives for us to get bigger. And in my core view, this thesis I'm currently working to, if you look at the hodlers like shrimp and crabs, right? We're talking about people under 10 Bitcoin. Their balance has been more or less flat for the last 12 months, right? They haven't really grown their stack. And I spent a lot of time thinking about this, and I think there's kind of 2 big reasons for this. The first one is that $1.2 trillion, it's painful. 0.1 Bitcoin used to be like 2 stacks away. Now it's like a multi-month venture. Like when you get there, it's an achievement, right? So at this scale, people's incomes just simply don't buy as much coin as it used to. But the other one, there's a lot of hodlers who've been around since 2013, 16, even 17, 18. They're now getting to the point where they've been stacking for 7 years. The additional stack is not making a marginal difference to their balance.
James hits on a fascinating point here about why we need derivatives in Bitcoin markets. As someone who's been in this space for over a decade, I've watched the natural progression of how people accumulate Bitcoin. In the early days, it was easy to stack a significant amount. The price was lower and your dollar went further. But now, with Bitcoin's market value over $1 trillion, it's become harder for regular people to build meaningful positions. Think about it. If you're trying to save in Bitcoin today, getting to even a small amount like 0.1 Bitcoin takes serious time and dedication. It's like trying to buy a house in today's market versus 30 years ago. The asset has appreciated so much that it's become harder for new entrants to build wealth in the same way early adopters did. This creates a natural ceiling for how much higher Bitcoin's price can go if we're only relying on regular people buying and holding. What's particularly interesting is how this mirrors other markets that have matured over time. Just as the stock market evolved from individual investors to institutional dominance, Bitcoin is following a similar path. The key difference is the speed at which this transition is happening. The traditional financial markets took decades to develop the infrastructure we see today, while Bitcoin has compressed this evolution into just a few years. And that's where Wall Street and big institutions come in, but they won't play ball without the right tools. Speaking of tools, let's hear what James has to say about exactly what these institutions need to participate in Bitcoin markets at scale.
So we're kind of in this eddy current or this estuary between the original kind of hodlers who got us here, but it's very hard to push the market up into the $2 trillion, $3 trillion mark, right? It's hard for retail to do that. You actually need the institutional capital to move higher. But at the same time, these institutions, they need derivatives, whether it be futures, mostly options, which is why this options thing is actually very, very important. Because if you want to allocate $50 billion, you need to be able to hedge that risk. And if the only way for you to hedge that risk is to short a futures contract or to sell spot, you just can't allocate the $50 billion in the first place.
What James is describing here is a crucial transition in Bitcoin's evolution. At 1031, we see this firsthand. The market has grown beyond what retail investors alone can support. Think of it like this. Imagine you're running a massive investment fund with billions of dollars to invest. You can't just buy Bitcoin and hope for the best. You need ways to protect your investment from dramatic price swings. That's where derivatives come in. They're like insurance policies for large investors. Without these tools, big institutions simply can't take the risk of putting significant money into Bitcoin. It's similar to how you wouldn't drive a car without insurance. the risk is too high. These investment firms have strict rules and responsibilities to their clients, and they need ways to manage risk before they can allocate serious money to Bitcoin. The introduction of ETF options is a game changer because it gives these institutions the tools they need to participate in the market responsibly. This isn't just about making it easier for Wall Street to trade. It's about building the infrastructure necessary for Bitcoin to grow into a multi-trillion-dollar asset. What's particularly fascinating is how this development could change the very nature of Bitcoin price movements. While some worry that institutional involvement might dampen Bitcoin's famous volatility, history suggests it might actually lead to more sophisticated and potentially larger price movements as these institutions deploy their capital strategically. The key is understanding that these tools don't just enable risk management. They create entirely new ways for capital to flow into and interact with Bitcoin markets.
So we're in this interesting handing over of the baton from retail, who got us to the size we currently are, to the institutions, and they do need the derivatives. They've got the ETFs now, they've got the futures, very soon they'll have the options. Then they actually have, options, the optionality to hedge their risk, which means they can now allocate serious capital. So we're in this transition period between retail dominant to institutional dominant.
This transition James describes is exactly what we're seeing play out in real time. From my perspective at 1031, watching this shift from retail to institutional dominance is fascinating. It's like watching a young athlete move from amateur to professional leagues. The game is the same, but the scale and sophistication are totally different. The retail investors, regular people buying and holding Bitcoin, got us to where we are today. They built the foundation by believing in Bitcoin's potential and holding through all the ups and downs, but to get to the next level, we need the big players: pension funds, endowments, and investment firms. These institutions manage trillions of dollars, and even a small allocation to Bitcoin could have a massive impact on the market. The derivatives markets, especially options, are like building new lanes on a highway. They make it possible for more traffic, in this case, institutional money, to flow into Bitcoin efficiently and safely. It's not about replacing retail investors. It's about adding a new layer of market participants who can help Bitcoin grow into its potential as a global monetary asset. What's particularly interesting about this transition is how it might affect Bitcoin's role in the broader financial system. As institutions gain more tools to interact with Bitcoin, we're likely to see it increasingly integrated into traditional financial products and services. This could mean everything from Bitcoin-backed loans to sophisticated investment products that combine Bitcoin with other assets. The key is that these developments don't change Bitcoin's fundamental properties. They just make it more accessible and useful to a broader range of investors and institutions. Let me know in the comments. Do you think institutions really need derivatives to invest in Bitcoin, or is this just Wall Street trying to complicate things? I read every comment, and I'm genuinely curious to hear your thoughts on this. Now that you've seen how derivatives could reshape Bitcoin's future, there's something even more important you need to understand. In our previous video, I break down why Trump might actually become Bitcoin's biggest buyer, and how this ties directly into the institutional adoption we just discussed. It's not a coincidence that these developments are happening at the same time. They're part of a bigger picture that's starting to emerge. Click the video on your screen now to understand exactly how nation-state adoption could amplify the effects of these new derivatives markets. And if you're serious about staying ahead of these market shifts, subscribe to the channel where we break down these crucial developments every single day. Stack sats and stay humble.